Welcome to the deep dive. We know you want the crucial info without getting lost in the noise.
Exactly, a clear signal.
And today, we're cutting straight to it. The recent Moody's downgrade of U.S. credit. What does it actually mean if you're an investor?
We're using a report from today, May 22nd, 2025, by Lucas Downey over at moneyflows.com.
Right. It's called USA Credit Downgrade and Forward Projections.
And our mission here is pretty clear.
Mm-hmm.
Understand what this downgrade really means.
Is the market reaction something to worry about or maybe something else?
Maybe even an opportunity. That's what the report suggests we should consider.
Now, the report acknowledges the recent stall in that big rally we saw.
Yeah, and some people are talking about, an elaborate, unsolvable debt spiral. Sounds pretty dramatic.
It does. But this report, it offers a different take, more evidence-based.
Exactly. It tries to ground the situation in historical data, not just scary headlines. A simpler explanation, maybe.
Okay, let's get to the core event then. Moody's last Friday.
Yep. They dropped the U.S. credit rating from a KIPI, the top level, down to AA1.
And the reason, what did the report say Moody's cited?
Well, basically it comes down to rising government debt over, the last decade plus.
And the interest payments on that debt.
Exactly. Those ratios, debt and interest payments, are now significantly higher than other countries with similar ratings.
So a bit more perceived risk compared to before.
That's the gist of it, yeah.
Okay, so that happened Friday. What about the immediate market reaction? The report details that.
Since Friday, S&P 500 down 1.9%.
Okay.
Small caps, which can be more sensitive, took a bigger hit, down 3.2%.
Right, that makes sense. It's not shocking to see stocks dip on news like that.
No, not really. It's pretty standard.
And bonds. What about Treasury yield?
Yeah. The U.S. 10-year Treasury yield, it jumped, reached 4.58%.
How big a jump was that?
It was 14 basis points in just 3 trading days. Pretty quick move.
And the report connects that yield jump directly to the stock drop?
It does. It uses that classic phrase, when rates jump, stocks dump.
An inverse relationship.
Yeah, they even included a chart showing that relationship between the 10-year yield and the S&P 500's relative return. Higher rates, generally tougher for stocks.
Okay. So while some, the bad news bears, as the report calls them.
Oh, yeah.
While they might be predicting doom, the report's saying, hold on, this reaction is kind of expected.
Pretty much. It's suggesting this is exactly the sort of market behavior you'd anticipate after a rating cut like this.
And that maybe, just maybe, it sets up a potential opportunity.
That's the pivot the report makes.
Oh.
It challenges that sort of catastrophe narrative.
Wow. By looking back.
Exactly. By looking at history. Have we been here before? What happened then?
Okay, so previous downgrades, which ones does the report highlight?
It points specifically to the Fitch downgrade. That was August 1st, 2023.
I remember that one. What happened to yields then?
Well, after that Fitch downgrade, the 10-year yield spiked, went up 100 basis points.
Wow, 100 basis points. How quickly?
Over about 2.5 months, from around 3.95% end of July to 4.95% by mid-October 23.
That's a really significant move.
It is. And the report also mentions the S&P downgrade, way back in August 2011, just as another data point for pattern recognition.
Right. So downgrades happen, yields tend to spike afterwards. What about stocks? What did the S&P 500 do after those previous downgrades? That's key for investors, right?
Absolutely. And the data there is pretty interesting. The report looked at the average performance after both the Fitch and S&P downgrades.
Near term.
Near term, not great. The average return for the S&P 500 1 month later was negative 1.7%.
Okay, a dip.
And even 3 months out, it was still slightly down on average, negative 1.5%.
So that fits the pattern we're seeing right now, doesn't it? The initial weakness.
It lines up very well. It suggests this initial pullback is kind of par for the course after a downgrade.
But you mentioned opportunity earlier. The report hints at a buy the dip idea. What happens after that initial weakness historically?
This is where it gets compelling. The report emphasizes the rebound, looking 6 months and 12 months out from those previous downgrades.
Okay, let's hear it.
Average 6-month return for the S&P 500, positive 9.7%.
Nice. And 12 months.
Even better. Average 12-month return was positive 17.5%.
Wow. Okay, so a significant turnaround.
A very significant turnaround. History suggests the initial pain tends to be followed by, substantial gain over the next year or so.
So the report's basically saying what we're seeing now, it feels bad, but it might just be act one of a familiar play.
That's the core thesis, yes.
Yeah.
That the current market action is following the historical playbook quite closely.
Short-term jitters, longer-term recovery potential.
Exactly. And the report actually drills down even deeper into the short-term stuff. Looks at different market segments, not just the S&P 500.
Okay, like mid-caps and small-caps too.
Yep, large-cap S&P 500, mid-cap S&P 400, and small-cap S&P 600. What happened in the immediate weeks after the past downgrades?
All right, let's get granular. Week 1.
Week 1, on average, large caps down 1.7%, mid caps down 0.9%, small caps down 1.9%.
Okay, pretty much down across the board. Small caps maybe a bit worse. Week 2.
Week 2 was tougher. Average losses. Large MAC of 4.7%, mid NAC of 5.1%, small negative 6.4%.
Ouch. So the pain could potentially intensify in the very near term.
It definitely could, based on that pattern. Week 3 still showed some drift lower too, though less severe.
What were the numbers for week 3?
Average losses of 1.7% for both large and mid caps, and 3.5% for small caps.
So this historical data suggests we might not be out of the woods yet in terms of immediate downside. That's the bad news part, I guess.
That seems to be the implication, yes. Further potential weakness in the coming weeks.
But this near-term volatility, the report frames it positively as a setup.
Right. It calls it a potential beautiful setup for longer-term gains, because despite that rocky start.
The 6-month and 12-month numbers we talked about earlier, kicking.
Exactly. And they looked at those longer-term returns across all 3 cap sizes, too.
Okay, so what did mid and small caps do 6 and 12 months out on average?
Good news there as well. Average 6-month returns, large plus 9.7%, mid plus 8.3%, small plus 9.6%.
So pretty strong across the board at 6 months.
Yep. And even better at 12 months. Average returns. Large plus 17.5%, mid plus 11.6%, small plus 11.7%.
Okay, that paints a much brighter picture longer term. Broad recovery.
Very broad. That's the great news part of the analysis. It suggests this could be a time to maybe think about playing offense rather than just defense.
If history is any guide, of course.
Always the caveat. But the historical pattern is quite striking.
And the report mentions institutional investors, the big money.
It does. It suggests that, big institutions are likely looking at this dip as a chance to put money to work.
Implying maybe individual investors could think similarly.
That seems to be the implication. If you have that longer time horizon and can stomach some near-term bumps, history suggests this kind of event has often preceded strong returns.
Okay, let's wrap this up then. Key takeaways for you, the listener, from this deep dive into the money flows report.
Okay, number 1, Moody's downgrade happened. It triggered a rate shock. Yields up, stocks down. Pretty clear cause and effect there.
Got it.
Number 2, this initial reaction, it actually lines up really well with what happened after the Fitch and S&P downgrades previously. It's not unprecedented.
Okay, history rhymes.
Right. Number 3, while the historical pattern suggests we could see more weakness, maybe across large, mid, and small caps in the next few weeks.
The bad news potentially isn't over yet.
Correct. But number 4, history also strongly suggests a significant rebound opportunity often follows, looking out 6 to 12 months.
With potentially strong double-digit average returns across the board based on past events.
Exactly. That's the potential opportunity.
So the core message from Downey's report is, don't panic based on fear-mongering headlines.
Yeah, resist the scary narratives. Instead, study history and follow the money flows, as the report puts it.
Look at the evidence, understand the historical context.
Precisely. Use that data to inform your thinking rather than just reacting emotionally to the day-to-day volatility.
That's a really valuable perspective, especially when markets get choppy like this. Okay, so a final thought then for you to consider.
How might this historical analysis shape your investment approach over the coming weeks and months?
Yeah. What signs or events would make you think this time is following the historical pattern? Or conversely, what would suggest maybe this time is different?
Definitely some food for thought there.
Absolutely. Thanks for joining us for this deep dive.